Welcome everyone to Concinnus Financial's 2016 Economic Outlook. My name is Nick Rossalillo. I'm the founder of Concinnus Financial. Started the company back in October of 2014. We are an investment manager and a financial services company based in Spokane, Washington. So Economic Outlook, we like to do this every January with the goal of not so much trying to predict what the future holds, but giving us some ideas of what could happen and what we individually can do to prepare for those possibilities. So what you won't hear in our presentation today, panic items that you can turn the TV on and watch on the news. We don't feel that those really do anything to actually help. So what you will hear today is some basic math and some economics, and how you can personally apply those to your personal situation. So an overview of some of the points that we're going to talk about. We'll start with macroeconomics, the big picture. What has led us here to this particular point in time? We'll also briefly take a look at United States GDP being one of the key economic indicators investors and economists look at for measuring growth in the economy. We'll look at international markets as a whole, what we see driving markets around the world in the coming year, and then our investment outlook, where we see an efficient allocation of investment money going forward, and then finally action steps, takeaways, what we can do personally with the information discussed. So first up, we have macroeconomics. So macroeconomics being the big picture when looking at an economy. What does the big picture look like? So when we break macroeconomics down into its parts, one of the first things we look at here is population growth. Is the population growing? That's a key ingredient for economic growth if you think about it. If you're a business and you're trying to grow your business, you're looking for new clients. One of the easiest way to pick up new clients if there's more people today than there was yesterday. So population growth is a key ingredient in growing an overall economy, and therefore also ultimately investment dollars that we put to work. So here on this slide we have three classic cases of a growing population, a stagnating population, and finally a shrinking population. So first on the left, in India, we have an example of a growing population. There at the bottom of that chart, those bars represent the youngest generations, and all the way up to the top, representing older generations of people. India's population is growing, and as a result, there are many more young people than there are older people. Moving to that middle graph there, in the United States, we have a stagnant population that's stopped growing more or less. And therefore we have roughly about the same number of older people as we do younger people. And then all the way on the right, we have the example of Japan, which is a shrinking population. There are now actually far more older people than there are younger people. And in fact, as a result, Japan's population is expected to shrink by about 25% over the next few decades if that trend were to continue. So an important ingredient in looking at economic growth is population growth. Are there more people available to consume the goods and services that businesses produce? Part one of our simple breakdown of macroeconomics, we had a look at population growth. In part two of that equation, we have average annual household income, or basically, what are families earning at work so as to pay the bills? So we can see how population growth and household income can kind of work in tandem with each other. Here we have a graph of U.S. household income over the course of the last few decades, and you'll see since about 1999, household income in the United States is down about 8%. So stagnant population, or basically the same number of people today as there were 10, 15 years ago, but those same number of people are making less money. We can compare that with Japan's outright shrinking population. Over the last 15 years or so, wages are down about 15%, while in India, with their booming population, wages have roughly doubled in the same time period. As a final look at our simple macroeconomic equation, we're going to take a look at specifically U.S. household debt. You can see that in the chart on the left. We also have corporate debt or business debt there on the right, but let's focus specifically on household debt. What do people like you and I have in the way of debt through our houses, our cars, our student loans, credit cards, so on and so forth? So you'll see this chart goes back to about 1950, and you see this huge surge in debt through 2007. And you can see there that total debt held by people like you and I here in the United States topped $14 trillion in 2007. And then you see it come down there through the last 5 years or so, but you see it starting to peak again there through this year. And in fact, we're getting right back to those same levels again, about $14 trillion in total debt that people like you and I are holding. So what does this mean? Let's think about all three parts of the equation together. We have the same number of people in the United States as we did 10, 15 years ago, making less money, but taking on an ever-increasing amount of debt. What's the takeaway? Well, we feel this answers a lot of questions about not just the current state of the economy, but how we got here in the first place. We can't continue to take on more and more debt without a corresponding rise in income or an increase in people that are holding that debt. So we feel that answers a lot of questions about where we're currently at. As far as takeaways, what this means for you and I personally, we'll get into that a little bit later. Just keep this in the back of your mind as we go through some of the subsequent slides here. So let's move on to United States Gross Domestic Product, or GDP. GDP is often used as an indicator of economic growth and health here in the United States. What is GDP? Simply, it's the total dollar value of all goods and services produced and consumed in a given year. It's typically calculated by adding together all dollars spent in a year and comparing that with the previous year's figure. So I've put here a very, very simple equation for how economists will put together these GDP numbers and calculate them. So the first part of the equation, C, total private consumption, or basically what everyday people are spending on stuff. Add that to total investments, including what businesses are spending and investing, and then adding in total government spending, the G part of the equation there, and then adding in the difference between exports and imports. So exports being goods and services produced here and sent overseas, subtracted by goods and services brought in from overseas. So in 2014, total GDP was about $17.4 trillion. That was the total dollar amount of goods and services purchased throughout the year. In 2015, that number is expected to be about $17.8 trillion. I say that's the expectation because we're still waiting for fourth quarter figures to be released. But basically that would indicate, by using GDP, a growth in the U.S. economy year over year. 2015's number was bigger than 2014's number. We feel one of the drawbacks in just looking at GDP is that it doesn't account for savings or the payoff of debt. So in previous slides on macroeconomics, we considered the fact that the average the average U.S. household has taken on a massive amount of debt with a correspondingly lower income every year. So if we think about GDP, then we have a problem. If we say that people spending less money than they did last year is bad, but gosh, if those people are saving more money and paying off some of that debt or deleveraging, that actually would be normal and healthy. So we don't feel that GDP tells the whole story. So we actually expect throughout 2016 we may see periods where you turn on the news and some economist is talking about a drop in GDP, a decrease in spending, and why we should panic about it. But we don't feel that's necessarily the case. Periods of shrinking GDP are normal and in fact healthy. It's only a problem if you never take a step back and save money or pay off debt. So keep that in mind as we progress through the year. So let's now take a look at international markets, or basically the global economy. And we feel that in the coming year, oil and energy will continue to dominate business headlines. I think this is a particularly appropriate slide because no doubt you've turned on the news or read an article recently in the last few weeks that have talked about the collapsing price of oil and the horrible repercussions that the global economy could see as a result of that. Now, we do think that is possible. There will probably be some negative repercussions for this drop in oil prices. However, let's take a look at the numbers here. So the collapse in oil prices has been blamed primarily on oversupply. And you can see in this chart, you're starting in June of 2014, we saw oil peak last at about $110 a barrel. It's dropped all the way down to today, January the 14th, 2016. Price is currently at just over $30 a barrel. So let's look at the supply, the actual supply and demand. Every single day, the world demands 96 million barrels of oil, and the world supplies 97 million barrels of oil. So about 1 million barrels of oil a day, every day, being produced extra. And we can see the results of that over the last year and a half, that collapse in prices. However, demand is expected to grow in the next year by about roughly 1.2 million barrels. So if nothing else were to change in the coming year, no businesses cut production or no oil producing country cuts production, we actually end up back at even, or if not, maybe even not having quite enough oil again. So the main takeaway here is we don't expect to see these suppressed prices at just over $30 a barrel over the long term. We expect to see a rise in prices as we progress through the year, and some of these horrible headlines that we're seeing to start to subside. So, just to beleaguer the point further, here is a chart that I've used quite often over the last year. This chart shows the break-even price for planned oil projects out through 2020. And as you can see, just about all of these projects require oil to be well over current prices, currently at about $30 a barrel, just to break even. And whether you're an oil company or whether you're an oil producing country, basically no one's making any money at current prices. In fact, most people are actually operating at a loss, and no one, whether business or a country as a whole, operates at a loss for forever. Here over the short term, we think that some of these countries, some of these companies are eventually going to cut production as a choice to hopefully reduce supply and raise prices, or will be forced to cut production because they just simply can't continue producing at prices this cheap, or some of these players will actually be forced out of the market altogether through possibly bankruptcy. So again, just to beleaguer the point, prices just simply can't stay this depressed for forever, where so many players are operating at a loss. This is kind of a fun slide I like talking about. This chart here shows the performance of major world currencies against the US dollar. And you'll notice again, this is recorded since June 30th, 2014. So this is something that's happened in tandem with the collapse of the price of oil. And in many ways, these two things are tied together. But basically, as you can see, the US dollar has appreciated in value against virtually all major world currencies. Some major world currencies have depreciated by quite a substantial amount against the dollar, others by a lesser amount over the last year and a half. But this is kind of a fun slide to look at. If you live in the United States and you have US dollars and you're thinking about traveling in the coming year, fantastic opportunity to travel overseas. You would be saving quite a bit of money on traveling internationally rather than here within US borders. There are some other implications, economic ones as well, that are important to consider with this as well. With such a steep rise in the dollar here in the last year and a half, that actually is a negative for the US economy. And in the short term, this collapse in value for many of these international currencies, it's a net negative for many of them in the short term. But over the mid to long term, that actually makes goods and products and services within those countries more competitive in the international market and here in the United States. So a little bit of a reversal in trend. We believe here over the short to midterm, we'll start to see some of these specifically emerging markets start to rebound and strengthen a little bit in their economies because of this appreciation in the US dollar. I'd like to round out our discussion first off with our investment outlook for the coming year. So I've put together here a sample allocation that we are using right now at Concinnus Financial for someone with a long-term outlook who is looking for growth over the long term. So again, this is just a sample. This is not specific investment advice for your particular situation. Please consult your investment professional for specific advice. But you can see here we have about 40% of a typical portfolio held in cash and other short-term securities like short-term bonds and treasuries. These cash and short-term positions are a nice cushion if we were to experience sustained drops in asset prices throughout the year. Moving over to the next section there, we do see having some exposure to U.S. stocks and also some international stocks, specifically emerging markets, being a good idea for a long-term investor. So you can see there 10%, plus or minus 10% into each category there. And moving over to the light blue section of the pie, we talked about oil and energy already. We see that over the long term as being a great opportunity. So allocating some money to the oil and energy sector specifically. And then finally, roughly 20% in some sort of hedging strategy. So in addition to that, cash and short-term security hedging can help buffer your portfolio against losses if we were to see that. So going back to those previous slides specifically about macroeconomics and GDP, if we were to see people starting to save more rather than spend more, that could lead to a drop in say, the stock market, as an example. And that cash and also possibly a hedging strategy could come in handy there. Again, not specific investment advice, for your personal situation, please consult your investment professional for help with your particular situation. Finally, I'd like to round out everything with a list of action steps for the coming year. I think this is the real meat of the discussion. How do we take all the information we just discussed and apply it personally? So I've broken it down into two columns, on the left side for business owners, on the right side for individuals and families, and you'll notice these bullet points are not all that different from each other. But at any rate, let's start with the left-hand side. If you're a business owner, it's the start of a new year. It's time to rework the budget, time to estimate how much money you expect coming in, and also along those same lines, expected expenses. Might be a good time to cut out unnecessary expenses, things that aren't absolutely essential for your business. So again, going back to previous slides on macroeconomics and GDP, if we were to have a drop in spending, that could cut into your business revenue. It's best to get ahead of that curve and cut expenses now rather than later once that revenue starts dropping. If you are looking at expanding business, opening up new markets, opening up new services, now might not be the best time to make an investment into perhaps a high reward business investment, but maybe a low probability of success. Instead, focus on value opportunities or maybe some simpler ways to increase business revenue. Also, increasing cash reserves, bolster up your balance sheet, and keep your key employees educated about your decisions in business and why you're doing them. And then finally, updating short and long-term business goals. Why did you get into business in the first place? What's your strategy going forward? Do you have an exit plan at some point in the future? Or whatever the case may be, we think now would be a good time to update those business goals. Moving over to individuals and families, first bullet point, I think the most important bullet point, it's time to rework or implement the family budget. I say implement because there are some estimates that say as high as 80% of people in the United States do not have a budget. It's very difficult to plan for the coming year if you don't have any estimate of what your income is and what your expenses are every month. So that would be a good first step. And then along with that, again, cutting unnecessary expenses for the family. And in tandem with that, also increasing your savings rate. The average American household saves about 5.5% a year. So again, thinking back to that slide on household income, what people are bringing home from work, it's about roughly $50,000 a year. That would mean the average family is saving $2,500 a year, $2,500, and that doesn't just include your savings at the bank, money you're stuffing under the mattress or burying in the backyard. That also includes retirement savings. $2,500 a year in savings just is simply not enough. And also being cautious about taking on new debt. Again, going back to previous slides in considering the massive uptick in debt consumption, be leery about taking on new mortgages, new auto loans, loans for education, and so on and so forth. And then again, finally, updating short and long-term financial goals. We believe that money is quite simply just a means to an end. It doesn't mean anything unless the money is there for a specific reason. So revisit what those short and long-term goals are. Why are you saving? Why are you investing? What are you working towards? Again, now is a fantastic time to revisit what those reasons are. Concludes our 2016 economic outlook. If you made it through all of the slides and you're still with me, I guess you must be one of those few people that doesn't find economics and math completely boring. Or if you do find it completely boring and you endured through it anyways, well, I applaud you. I hope that you found some of the information to be useful, something that you could take away and put into action in the coming year. If you do have any questions or comments on any of the material presented, feel free to get in touch with us. You can also follow us on LinkedIn, on Twitter, and also on our YouTube page, where we frequently update that with our research and our thoughts on the economy and investing. Also, if you need any help implementing any of the strategies we talked about, also please feel free to get in touch with either myself or with Stephen. I'd like to thank you again for listening in, and we look forward to hearing from you in the future and seeing you on our future presentations.